Okay, people, we're now moving into a very similar concept when it comes to audit engagements. So at this point, you know that conceptually an audit is an assurance service where the auditor is opining on the financial statements. Okay, but we know that that is an opinion that is being presented for the financial statements only. Okay, we're now going to introduce what's referred to as an integrated audit. An integrated audit is an audit that combines two or more types of audits, such as the financial statements, as well as the audit of internal controls over financial reporting. Okay, so this is all getting lumped into one single unified audit report. Okay, so not only are we now having an opinion on the financial statements, we also have an opinion on the effectiveness of internal controls, right? So once upon a time, there was a company called Enron. The tale of Enron turned out to be one of the biggest fraudulent scandals uncovered in audit history. And what investigators found out was that this fraud could have been prevented or uncovered earlier had there been stronger systems of internal controls. Okay, so now there is this requirement for Max at Accrual World, who is now required to report on the effectiveness of internal controls in addition to the accuracy of the financial statements. Thanks a lot, Enron. Okay, so let's take a step back and let's define the word integrate. This means to combine one thing with another so that they become a whole. So when tying this back to the auditing concepts, we're now going to be combining one thing with another so that it becomes whole. Okay, so what is that one thing with the other? We're combining the financial statement audit with the audit of internal controls. So while integrated audits are required for issuers, that doesn't necessarily mean that non-issuers won't perform integrated audits. And more importantly, this doesn't mean that the exam doesn't want you to know the rules for integrated audits, specifically for both issuers and non-issuers. Okay, so while integrated audits are required for issuers, there is a little nuance to keep in mind. So this has to do with Rule 404. So Rule 404 is really just saying that certain types of public companies are required to have an audit over their system of internal controls. So who is this specifically applicable to? So what you need to remember, or at least keep in mind, is that this specifically pertains to accelerated filers and large accelerated filers. So an accelerated filer is one where a company has between 75 million and 700 million of its market value in common stock that is held by outsiders, okay? So by third parties or affiliated shareholders. Whereas a large accelerated filer is 700 million or more. Okay, so on the exam, what you need to keep in mind is that the question is generally just going to say that this is an issuer or that it is a non-issuer. But if you see these numbers between 75 million and 700 million or over 700 million, a little red flag needs to go off in your brain that says that this has to do with the specific types of companies that are required to have an integrated audit performed on both their financial statements as well as the effectiveness of their internal controls.
Hey guys, I hate to interrupt, but I just wanted to take a moment to say if you're studying for the CPA exams and you like the visual learning approach that we take in this video, definitely check out Universal CPA Review's free trial. You can do this by going to www.universalcpareview.com, or you can click on the link in the description of this video. From there, you could take a sneak peek at Universal's platform, which includes animated video lectures, study guides, and practice questions with task-based simulations that come with video explanations that walk you through the solution step by step, kind of like having a tutor by your side. Okay, enough of that. Let's get back to it.
All right, so keeping our heads on straight, we're still thinking about how integrated audits compare to good old-fashioned financial statement audits. Okay, so some of the key differences are as follows. At this point, we know that integrated audits will provide an audit opinion on both the accuracy of the financial statements as well as the operating effectiveness of internal controls. But there are a few additional facts to keep in mind. Integrated audits are technically required for issuers and technically optional for non-issuers. Okay, so required for public companies. There is more evidence that will be required for an integrated audit, right? We can't forget that we are going to be opining on both the financial statements accuracy as well as the operating effectiveness of internal controls. Okay, so there's going to be more evidence that is required in order to obtain and outline that opinion on the internal controls' overall operating effectiveness. Something else to keep in mind is that integrated audits will be dated as of a specific date, whereas financial statement audits are based on an entire year or sometimes multiple years. Okay, so you can have an integrated audit as of April 30th of the current year. So remember, for financial statement audits, we need to understand the differences in management's responsibility versus the auditor's responsibility, right? We remember for financial statement audits that management is responsible for the fair preparation and presentation of the financial statements, plus the design, the implementation, and the maintenance of internal controls. Whereas Detective Lucy, the auditor, is responsible for actually performing the audit engagement as well as opining on the financial statements. Okay, and the reason I'm refreshing that is because it's going to be important that you understand the little nuances when it comes to management's responsibility and the auditor's responsibility in an integrated audit. Okay, so we have an integrated audit that can be performed for both issuers and technically also non-issuers. So let's understand management's responsibility first for both issuers and non-issuers. Okay, so Sarbanes-Oxley Act of 2002 requires this section 404. Okay, so we know that an issuer will be required to have this integrated audit. So let's say that Accrual World is a publicly traded company, and Detective Lucy is now opining on both their financial statement accuracy as well as the effectiveness of internal controls. All right, so what is management required to do in order to cooperate with Detective Lucy? So they are required to state that they are responsible for establishing and maintaining an adequate system of internal controls and their written representation on the effectiveness of internal controls. Okay, so some key words that we need to keep in mind that can be thought of as your buzzwords for management's responsibility in an integrated audit for issuers is financial statement preparation. Okay, so we know that they need to prepare the financial statements. This is still an audit on both internal controls and the financial statements, and they are still responsible for designing and maintaining internal controls. Okay, they're also going to be responsible for identifying any risks or significant risks, as well as providing access to information. Okay, and one of the big ones that you need to keep in mind is written representation. So management is responsible for providing representations to the auditor regarding the completeness and accuracy of financial statements, as well as documentation provided to them during the audit. Okay, so they like to include written representation when talking about management's responsibility on the exam. Okay, so we talked about management's responsibility for an issuer. What if this was for a non-issuer? Okay, so management is still required to facilitate the audit process and ensure the accuracy and completeness of the financial statements related to internal controls. So with that being said, they also have these responsibilities, which typically include very similar stuff as management would have when we're talking about an integrated audit for an issuer, in that they are still responsible for preparing the financial statements and designing internal controls. Okay, but they're also going to be responsible for evaluating the effectiveness of internal controls. Okay, so management is responsible for evaluating the effectiveness of internal controls over financial reporting and for reporting any deficiencies in these controls to the auditor. Okay, so they're also going to be responsible for providing written representation. Okay, so management is responsible for providing this written representation as they would if this was for an issuer. Okay, right, they're saying, look, Detective Lucy, we are providing you this written representation and we're saying that we are complete and accurate in terms of our financial statements, and we are letting you know about any potential fraud or illegal acts. Okay, and then finally, they're responsible for disclosing all relevant information. Okay, so this can include any known or potential risks or uncertainties that may affect the company's financial position or performance. Okay, so when you're thinking about integrated audits, this should always be associated with internal controls in your brain. So when you're thinking about an integrated audit, you're thinking about internal controls and specifically the auditor having an opinion on the overall operating effectiveness of internal controls. So we talked about management's responsibility. What about the auditor's responsibility? Right? What is it that Detective Lucy is responsible for now that she is opining on the overall operating effectiveness of her client's internal controls? Well, how about testing internal controls? if she's coming to an opinion on the overall operating effectiveness of the internal controls, wouldn't it make sense for her to test those internal controls in order to come to the appropriate conclusion? Yes, it would. Okay, so the auditor is responsible for testing internal controls, and specifically within an integrated audit, the auditor will be responsible for performing the same tests of internal controls as management would use when they are evaluating their overall effectiveness of their own internal controls. So, test of internal controls should be designed to provide sufficient appropriate evidence in determining audit risk factors, as well as the operating effectiveness of internal controls. So, what we're going to learn about a little bit later on in this course is something called the COSO framework. And basically, the COSO framework is this framework or rule book that management is going to follow when they are designing their internal controls. All right, and the 5 elements of the COSO framework consist of the control environment, risk assessment, information and communication systems, monitoring, and existing control activities. Okay, so when the auditor is testing management's internal controls, some of the procedures that they will perform include walkthroughs, inquiries, observations, and inspections. Okay, so pretty intuitive what each of these would be if you take a step back and think about what it is Detective Lucy might be looking for. Okay, so maybe an observation could be Detective Lucy doing a walkthrough of the client's warehouse. Inquiries could be asking management or the CFO questions about the company. Walkthroughs, same concept as observations, and inspections could be when the auditor is specifically inspecting documents. Okay, so taking a step back now and thinking about what the auditor is actually doing here. The auditor's work in an integrated audit will have a greater scope than a standard financial statement audit. And that makes sense because they're going to have to perform more procedures to obtain sufficient appropriate evidence. They're now doing more work. They're going to now be auditing the financial statements plus auditing the overall operating effectiveness of internal controls. Okay, so something to keep in mind there as well.